MGM Resorts just reported net income that more than doubled, up 111%, and diluted earnings per share up 127%. On the face of it, that looks like a business that has stepped up a gear. But operating income over the same period grew just 1.9%, and operating cash flow actually fell. In this video, we take apart the first 6 months of MGM's fiscal 2026 straight from the 10Q and work out where that earnings surge really came from and whether it is the kind of thing that repeats. MGM Resorts International is a casino and hospitality operator. It runs integrated resorts on the Las Vegas Strip, regional casinos across the United States, a majority stake in MGM China in Macau, and an online gaming and sports betting arm reported as MGM Digital. Every figure in this video comes from the 10Q for the 6 months ended the 30th of June 2026. That matters. The income statement and cash flow numbers are cumulative first half figures, not a standalone quarter, and they compare to the same 6 months a year earlier. Balance sheet items compare to the prior fiscal year end. Start with the top line. Revenue for the first half came in at $8.91 billion, up 2.6% year over year from $8.68 billion. Operating income was $804.9 million, up 1.9%. So operating profit grew more slowly than revenue. Below that, the picture changes completely. Pre-tax income was $615.8 million against $400.5 million a year ago, up 53.7%. Net income came in at $417.6 million, more than double the $197.5 million of the prior year, and diluted earnings per share reached $1.59 against 70 cents. Here is the central point of the report. Operating income rose by about $15 million. Pre-tax income rose by about $215 million. That entire gap was generated below the operating line in interest, other income, or equity method items. The filing data in front of us does not break out what it was, which is precisely why it cannot be treated as repeatable yet. There is a second amplifier. Diluted share count fell from 282.3 million to 258.3 million, down 8.5%. That is why earnings per share grew 127%, while net income grew 111%. And the comparison base was weak. Last year's first half converted roughly half of operating income into pre-tax income, against about 3/4 this year. Now the segments, because this is where the real operating story sits. Las Vegas Strip Resorts is the biggest business by far, $4.35 billion of revenue, 48.9% of the total, growing 1.4%. MGM China contributed $2.22 billion, 25% of revenue, up 4%. Regional operations, the domestic casinos outside Las Vegas, brought in $1.84 billion, 20.7% of the total, and shrank 1.2%. And MGM Digital delivered $379 million, up 29.8%, the fastest growing part of the group by a wide margin. Put those four numbers together and the concentration problem becomes obvious. The fastest growing segment, digital, is only 4.3% of revenue. Growing that at 30% adds roughly $87 million, real but small, against an $8.9 billion base. Meanwhile, Las Vegas Strip Resorts and MGM China together account for 73.9% of revenue, and between them, they grew at 1.4% and 4%. So the group's growth rate is effectively set by Nevada visitation and by Macau's gaming cycle, while the part of the business that is actually compounding is too small to move the total yet. Regional operations going backwards tells you domestic demand outside Las Vegas is not helping either. Follow the margin down the income statement, and you can see exactly where value was created and lost. Revenue grew 2.6%. Selling, general, and administrative expense grew 7% to $2.55 billion, nearly 3 times the pace of revenue. That is negative operating leverage, and it pushed operating margin down to 9.0% from 9.1%. Then below the line, the non-operating swing lifts pre-tax income sharply. Tax expense rose to $118.2 million from $55.7 million, but not enough to offset it. and net margin ends at 4.7% against 2.3% a year ago. The full 2.4 percentage point margin gain is a below-the-line event. Line the two reported periods up side by side, and the divergence is the whole story. Revenue moved from $8.68 billion to $8.91 billion. Operating income moved from $789.6 million to $804.9 million. Operating margin moved from 9.1% to 9.0%. Those three lines describe a business that is essentially flat. Over exactly the same two periods, net income went from $197.5 million to $417.6, and return on equity from 5.3% to 16.6%. When the operating lines barely move and the bottom lines double, the explanation is never in the operations. Cash flow is the referee, and it delivers a split verdict. In level terms, the profit is well covered. Operating cash flow of $1.13 billion is about 2.7 times reported net income, which is normal for a capital-heavy resort operator. But the direction is the problem. Operating cash flow fell 5.6%, from $1.19 billion in the same 6 months that net income doubled. Cash generation went down while accounting profit went up, independent confirmation that the earnings jump was not a cash event. Free cash flow was $730.6 million against $696.5 million, up 4.9%, but that improvement came from spending less, not earning more. Capital expenditure fell to $396 million. The capital allocation picture has shifted noticeably. Share repurchases were $262.5 million in the half, down from $717.2 million a year earlier, a cut of roughly 63%. Investing outflows narrowed to $109.1 million from $605.3 million, and financing outflows to $550.8 million from just over $1.06 billion. Less capex, far fewer buybacks, much less investing activity, and cash on the balance sheet up $484 million. That is a company conserving cash rather than deploying it. Note the tension, though. The buyback is what shrank the share count that flattered earnings per share, and it is now running at roughly a third of last year's pace. The balance sheet is where the constraint lives. Total assets stood at $39.85 billion, down 3.7% since the start of the fiscal year, and total liabilities at $36.47 billion, down $1.63 billion over the same span. Against that sits equity of just $2.51 billion, up modestly from $2.43 billion at the start of the year, though down about 24% from the interim balance at the end of March. That gives debt to equity of 14.51 times and return on assets of 1%. Two consequences. The 16.6% return on equity is flattered by a very small denominator, and long-term debt of $6.07 billion is only a fraction of total liabilities, meaning large non-debt obligations, most likely leases, cite in that base, and the split is not disclosed here. Liquidity itself is adequate. Cash of $2.55 billion and a current ratio of 1.33. On insider activity, there is genuinely nothing to read. Zero open market purchases and zero open market sales. The 6 reported Form 4 transactions are all mechanical. The president of Interactive settled previously granted awards through 2 option conversions of 2,259 shares each, with 903 shares withheld to cover tax. 3 directors, Paul Salem, Keith Meister, and Joseph Levin, received routine stock grants of roughly 2,837 and 732 shares. Grants and withholding are not decisions to buy or sell. The only corporate event in the window is the 8th K of the 29th of July, which furnished the results release without figures in its body. The substance sits in the same day 10Q. 4 things decide whether this half was a turning point or a one-off. First and most important, identify the source of the roughly $215 million non-operating gain. Until the next filing names it, recurring earnings power tracks the 1.9% operating line, not the 111% headline. Second, watch whether operating cash flow reconverges with earnings or keeps falling. Receivables rose 8.5% to $1.22 billion since the start of the fiscal year, outpacing revenue growth. Third, whether SG&A growth of 7% is brought back in line with revenue, because that alone took operating margin down. And fourth, whether MGM Digital can hold roughly 30% growth and turn scale into segment profit. The one-line takeaway: MGM's earnings doubled, but its business did not. Revenue up 2.6%, operating income up 1.9%, operating margin slightly down, operating cash flow down 5.6%, with the entire profit surge arriving below the operating line and amplified by a smaller share count. The genuine positives are real but narrow. Digital compounding near 30% off a small base, Macau up 4%, liabilities and assets both shrinking, and cash up. Set against a 14.5 times debt-to-equity structure, this is an operationally flat, highly levered business whose reported momentum currently comes from mix, share count, and non-operating items rather than from the core resort engine.